Welcome to the Brew. Today, Traders Workshop Thursday. The straddle is your hammer. We are going to talk about the straddle. Mark Phillips broke this down in his latest blog. So we're going to get into it. The straddle is one of my favorite tools for options trading. So let's get right to it on the opening bell. Good morning, gents.
Going on,
Good
Lex?
morning,
How
Lex.
are we? How are we? Are we good?
Doing all right, Lex. Doing all
So
right.
here's the deal. Today is, I think, the longest day of the year.
What are your big plans for the solstice?
Well, yeah, and the solstice, that's a good one. I was gonna have a cocktail tonight. It would be the first one of the week. That's a lie.
Wow.
It's not the first one of the week. It's not. No, it's not the
The
first.
summer solstice, what are you drinking, a margarita over there?
Yeah,
or-
I'm gonna go margarita solid. What do you think?
I'm a huge fan of that.
Yeah.
Have you been depressed or anything? Or
No. It's just been an unbelievable. I didn't even know I had off yesterday on Juneteenth, and I'm like, once I figured it out, I scheduled a whole day of activity. It was just awesome.
yeah.
So
My,
now I know what you guys do most of the week. When you rich guys for just hanging around on a random Wednesday.
Yesterday was a holiday?
Yeah, market was closed. Mark.
Oh, I didn't notice.
Yeah. Sweet.
Normally I have kids all running around here, but they're at sleepaway camp, and so I got some time. I don't know what I'm gonna do with myself, Lex. You're gonna have to teach me how to make a cocktail.
I know, right?
Bring it to the pool.
No, it's been a tough week. This feels like a true summer week. So, anywho, all right, let's get to it. What do you say? I loved your blog, Mark, on the straddle is your hammer. Let's go into that a little bit. I love the straddle. I don't like buying straddles necessarily, but we'll get into that as well. But it's a great barometer, right? So
Yeah, I couldn't agree more that of all the trade structures out there, rarely am I buying straddles, rarely am I selling straddles, but I think about straddles a lot.
Same here, 100%.
Yep.
I think it's, so let's get it. What does the straddle really tell us? First of all, let's for some of the beginners, let's just say what a straddle is. First of all, let's define that. Who wants to fly on that one?
I will, because I'm sure Mark will be talking for the rest of the episode. So, a straddle is a option strategy that you could buy a call and a put at the same expiration at the same strike.
Okay, got it. Easy enough. So you can either buy the straddle or you can sell the straddle, and they have very different P&L profiles. Clearly, the long straddle. Okay, you're buying, like Jason said, you're buying the same strike, same expiration, call and put, and typically it's in equal parts, right? It's 1 by 1, it's 2 to 2, whatever. I've seen ratioed straddles before, but we'll save that for another day. So the graph of that trade is at expiration is a V with the strike price of the straddle at the lowest point if it expires there. So you pay premium, right, for that long straddle. It costs you something when you buy it, right? It's pretty expensive because typically you do straddles at the money, typically, right? You don't have to, but typically you do. So that's the worst point. You need that sucker to move away from that strike by expiration point. And you get what? What else do we get with the Greek profile? You get gamma. So, how would you guys describe the rest of the Greek profile? Delta, gamma, theta, vega, rho.
So if the straddle is at the money, then you are delta neutral. But your gamma is with the straddle, your gamma is the highest at the money. So you need it to swing one way or another in order to make money. But the price of gamma is theta, and your theta is deeply negative. You lose quite a bit of money on a straddle. So essentially what I guess I'm getting into the Mark thing, but essentially what you're saying is that options are underpriced when you buy a straddle.
Yeah, or Mark will talk to us about this, or the expected move that the straddle is predicting is cheap in your opinion. It's not dear enough, so you'd purchase it. So Mark, let's get into that a little bit. Unless you have some other things to add here about Mr. Straddle the hammer.
No, I think it's great because of that. And it's sort of the purest conversion of that implied volatility figure. It's a very Vega intensive trade, like you're making a very distinct bet on vol, but it's defined in dollar terms. That expected move is, denominated in dollar terms. So it's very easy to say you're struck at the money. Buying that straddle says, I think it will move more than X, the dollar price I'm paying. Not
right.
Above this strike, not over this strike. It's moving more than X or it's moving less than X. And it's just a very direct expected move. So that makes it useful for broadly determining what the market expectations of a movement to a given expiration are. What's our weekly straddle on Monday? What's our CPI straddle and our event straddle and earnings straddle? So it's just a perfect dollar denominated single figure that tells you where vol is going, but also what rates are too. Rates have an interesting impact on straddle prices.
Right. So let's you're right. Let's talk about that last, the rates. That's probably the most confusing. But so if a straddle's, tomorrow expiration is $20. Oh, did I get a thumbs up?
No, I just wanted to get into the geeky stuff.
Oh, you're gonna get in the geeky stuff. We gotta get the easy stuff out of the way first. If a straddle's $20 and it expires, I'm making this up, on Friday, let's say tomorrow. What does that tell us about the expected move of the stock? It's not exactly 20, right? Per se, or do you feel it is exactly 20, according to the pricers?
I would say the simplest answer is yes, it's exactly 20. I think you can, and for most intents and purposes, that's accurate. But as a true, like the option is priced as like a replication. Like most models are a replication, a delta hedged replication value of that. So I think if you really wanted to parse it, it's probably more accurately the cost of maintaining a short volatility position in that over that time, and delta hedged out.
Right.
But for most use cases, I think you're simple. That's the movement. Is going to work.
So
the other.
Go ahead. Sorry, Jason. Go ahead.
Sorry. The other thing to note too is, just because it's a $20 straddle doesn't mean that it's equal movement. It's not a normal bell curve necessarily. It could be skewed left or right. If the calls are $15 and the puts are $5, which is pretty extreme, that's telling you something about the skew of the expectation.
So, but okay. So if I have a $20 straddle, is that in essence? I know it's not exact. In essence, saying that 68% of the time, one standard deviation, that stock is going to move within $20 of the strike of the straddle price. Is that safe to say?
Yes.
Okay. So what I like to do at that straddle price is, especially if I'm a 0 DTE iron condor seller, right? I like to get that number first. Anytime I'm doing short premium trades, I like to know what that straddle price is, and then I will place my shorts, at least there and probably beyond to get a little more standard deviation out of it, right? So that's what I like to do. It gives me a thumbnail of, okay, this is expected move up or down, right? I'm gonna buy myself a little more production, go out a little farther, put my iron condor on, and see how I do. Right? Any thoughts there?
I think the 2/3, because like that's sort of in like a normal distribution mode, and Jason was sort of hinting at this a little bit before with like some skewness or whatever, that to the extent that like a straddle might be slightly overpriced because there's also some skew premium to that.
Right. That's a good point. Right.
But like it's not necessarily gonna win exactly that 2/3 of the time or whatever, but like it's the P&L also of those extreme cases that has to be taken into account.
Mm-hmm. Right. Okay. Cool. And again, I always say it's not exact because I want to talk about that formula a little bit before we get into the geek squad here. But Mark, I'm going to let you go right into it with your interest rate sort of computation or analysis on straddles and how interest rates affect that. So now we're talking about maybe a little row stuff, right?
Well, they start to get a little bit funky, right? Like imagine an extreme example where, you have a negative 50% rate or something like that. That's going to move the at the money forward strike value around. And so your dollar price right now of where stock is, that at the money isn't going to be the same as the straddle price when it's, a negative 50% rate 3 months out. That your straddle like struck here at spot is different than the deeper in the money, or the puts are going to have a lot more value in that negative 50% case.
Right. So all of a sudden, that since the puts have more value in a negative interest rate scenario, right? What looks like at the money isn't going to have the same premium on the call and put. Very different, right?
Right. I would say straddles are long row. Yeah.
Yep.
Okay. Fair. Okay, good. What about, so we talked about gamma being positive for long straddles, negative for short straddles. Theta, Jason, you mentioned if we're long that straddle, where our price to own it is the theta, which is extreme, extreme relatively speaking. It can be not so extreme in low volatility environments, but there's a reason it's priced there because it's a low volatility. So I always found that to be kind of a perplexity. I always want to buy straddles when it's low, but it doesn't move anyway because it's low.
Right.
Vega. What about Vega? We didn't talk about that yet.
Plenty of Vega to a straddle.
Vega straddle is a Vega trade. You're presuming that it is the options are underpriced.
Right, but meaning if you're long to the straddle, we're long Vega, right?
Yep.
Opposite on the short side. Okay.
Yep.
So we both, all of us kind of said, maybe Jason did, but Mark and I said that I never really buy and sell straddles as a strategy.
I don't either.
Why not?
Well, I mean, I don't buy a straddle because typically, options are overpriced. I mean, there's plenty of statistics, that show that premiums are typically higher than the movement of the underlying options. That being said, selling a straddle requires a lot of margin because if you're selling a straddle, then you're selling a naked call, which has an infinite loss profile, and you're selling a put, which has a very, very large loss profile. So it requires a lot of margin in order to sell a straddle, which is typically why butterflies are usually the better choice. But buying a straddle is usually kind of a losing proposition to begin with. So,
yeah, unless you have opposing shorts against it, which all of a sudden becomes a potential iron butterfly, which will be another episode.
Well, if
my new favorite trade, by the way,
if you're buying a straddle, then putting shorts on the other side is buying an iron butterfly, or it's short an iron butterfly.
I call it. I don't know. We always argue this. If I buy the straddle and sell the wings, I always call that a long iron butterfly. I don't know.
Yeah,
I'm paying for it.
That's long because you're premium wide, I guess. I don't know. That's
semantics.
Semantics.
Okay, cool. So Vega, we talked about. We got Delta. Well, Delta, they're both about 50 Delta. That's safe at the money. Gamma, we talked about. Vega, Theta, Rho. Right? Okay, Mark. More of the Geek Squad. Ready? What about the calculation for honing this value down to a 1 day standard deviation move, or a 1 week, or a 3 week, or a half a year? Tell us about that. It's in your paper a little bit, and we use some square root functions here, and I might be able to draw this on the screen if you walk me through it. So what do we know about that?
Sure. Well, I think one of the things that's interesting or useful, particularly useful about a straddle, is that it defines a dollar-based move. And we think about stocks like we think about dollar moves. That's very intuitive for us to understand. So there's often a demand, or often it's interesting for us to think about, okay, implied vol in ticker XYZ is 42.7. Well, how much does that really mean it's going to move? That means a different thing in a dollar amount in Apple than it means in NVIDIA, if it's the same vol. So we want to think, okay, how much is this actually going to move? I've got an implied vol number. I need to turn that into a dollar amount.
Right. So can you see my screen?
Yep.
Okay. So here's my implied volatility number. Tell me about the calculation. So sometimes people don't use this part to get the actual movement of the underlying in question, this part here, right? They don't use that part as much. And in your calculation, you get a percent move for that stock for the time period in question, and you remove this stock price part. So it'd be IV, right, divided by the square root of time. Is that right?
Yep, IV divided by square root of the time is going to give you the is going to convert that annualized implied volatility figure into a dollar move for that square root of time period.
Yep.
And of course, if you multiply a percentage by the stock price, that'll be how many dollars.
That's exactly what this part of the equation gives you, is that percentage. And then when you multiply it by that, it'll give you in that particular stock what that expected move is there, right?
Yep.
All right, cool.
An important nuance of this, right, or an important reason why this simply works is because all the IV numbers we're talking about are annualized numbers.
Correct.
So like even if you're looking at the weekly expiration or the monthly expiration, like all those numbers are annualized in vol terms. Because that's like what the model spits out and we interpolate from. But converting that to the square root of t, that t figure is a day figure. A trading day figure that you'll want to use. Okay,
so what we did in the day was this T number we always refer to it as 252 because that's the number of trading days in a year. Now, it can be argued, do you use that or do you make it 365? Do you include the weekends? What's right there? What's correct there? Because stocks don't trade on the weekends, right? So we always use 252. People argue otherwise. And I think it comes out to be 15.87. People round up to 16. Right? Is that pretty typical? Is that how we get to the 16?
Yeah, I think that's the shorthand calculation. Just like take your IV number divided by 16 and you're going to get a pretty good, back of the envelope estimate.
Right. So here's the tricky part, I think. Let's talk about this real quick. So what happens when we get not from a 1 day dividing this by the square root of 252, but what about like a 3 month? What do we put for T there?
So if you think about T as being the conversion of this annualized figure into a daily figure, if T is 252 and we take 252 divided by 252, that's of course 1. Square root of 252 or square root of 1 is 1. And the IV number is just the IV number, the annualized figure. So over 252 trading days, we have our annualized number.
Got it.
If you want to divide that for, say, a 6-month period, you would do 252 divided by the number, the number of days divided by 252. So half of 252, 176 divided by 252.
So we want 176 divided by 252, whatever that comes out to be.
Sorry, no, I was right the first time. It's 252 over the number. Square root of 252 over, say, 176.
Yeah. And so that's going to be and then that's going to be that period range when you get this number here, when you compute that, right? For implied volatility and expected move.
Correct.
Okay, cool. I saw another formula. I got to think about it because I'd have to look it up and I don't have it handy. I apologize for that, but we'll post it.
So the 2-day move might be interesting, or the 1 week move. You put a 5 in there or something.
Sure.
So then you're doing the square root of 50. You're divided by 7 instead of divided by 16. So of course that's going to be a bigger realized number.
Right. But the other thing I always talk about this, and it's kind of like lobbing grenades, right? If I use the straddle price, I get close. Right? I don't have to really hit the target. I just have to kind of be in the ballpark. So if I want to go out and look at a 6-month straddle, I'm going to compute that price. It's going to give me an idea of what this expected move is. Now I know volatility changes, I suppose, but so would all this other stuff too, because this number, if volatility changes, so does that, and this calculation changes, right? So I like using something like that to kind of just get me close. Lob my grenade near it. I hope I do some damage.
And then recalibrate. And then, the grenade hits over there. Well, you got to tweak the vol a little bit and then shoot that direction.
Yeah. Now, what is this calculation right here? Oh, that's longest day of the year. That's what that is. That's today. Okay. That's what I wrote down for there. Okay. That doesn't mean anything. So don't worry about that. Here's what a long straddle looks like on expiration. So remember what we said, we want movement here on the long straddle, right? This is the bad point, whatever that strike is at the money. We make money down here, on big extreme moves. And then the opposite is true for the short straddle. Our profit is here. We want it to kind of expire and rot away here. Theta is working our way. We collect that straddle premium that we sold. Do you guys have a preference of which one you like better? I like the short side better because I like taking a little risk. But guess what? In the retail world, you got to be able to do this with the rest of it, right? Because, unless you have a ton of money, you're not going to be able to be naked straddles typically, right? So this all of a sudden becomes some sort of butterfly or iron condor or that kind of thing, right? When we peel these wings up. And that's why those strategies are so good, I think. Thoughts?
Short the meat, long the wings.
Yep. That's right.
Yeah, especially on OPEX, if you're doing something today, we probably, I was saying this, we're probably going to pin at 5,500. That's where, I don't know what the price is right now. But,
like you're talking about today, we're going to pin at 5,500? Is that a prediction?
For most of the day, yeah.
Okay, that's good because
there's a lot of calls today at 5,500.
Oh, I love it. That's what I need the stock. I need the SPX to be outside of 54.95.
Outside of 54.
Well, beyond it. Beyond it.
Well, there you go.
Do you know why? Do you know why? This is good because I bought the straddle, which I just said I never do. I bought it on Tuesday. We had the day off on Wednesday. I mistakenly tried to buy it for the next day, but I realized after I bought it that, I paid too much for it because it's 2 days away because we're off on Wednesday yesterday. So I bought the straddle and I sold the strangle or sold the wing. So I was into the long iron butterfly. It's my new favorite trade. So I need movement there, but I'm not going to feel the pinch of the whole amount because I sold something against it. So whatever I paid for that spread, I'm making it up. Let's say it's $8 and it's a $10 version. It can go to $10 if it moves, or it can rot all $8 away, right? Sounds horrible, but if you look at expected value of these things and probability of profit, it starts making a little sense, right? Yeah. It starts making a little sense. So it's my new favorite trade. So I get to be long a straddle for a day, or plus some wings, short wings to kind of defease it, and I can get out. These things trade at $9.90 before the close. You make your money. It's kind of fun.
Nice. Yeah, the only thing that would derail the whole 550 or 5,500 pin would be if somebody started closing their calls. But
yeah,
that last month, what was it? Monday, we had like that pretty, it was like 40, 50 point move. And when you looked at the options, when you looked at Voland, all of those calls that were closing in the money got rolled up to 5,500. All of a sudden, the gamma on there went up, 2x.
Right.
In the day. And it was like, oh, well, look at that.
Yeah, that's interesting. Well, good. I'm glad to hear that. I'm gonna go with it. Although this, I got to be honest. We're gonna go in a second, but this market is insane, just insane. The power of it.
Yeah, it just keeps going up.
Every day I look at it. Oh, it's up again. Wow, this is fun. I didn't like those days as a trader. The straight moves in one direction. I don't think, especially the up moves. As traders, market makers, we want, wild swings and chaos and mispricing. We want stuff all over the place. The straight up moves are very systematic. It seems like, and pricing. You get lazy, I think, with pricing, or it just feels lazy at least, right?
Well, I think the psychology of it is very hard too, right? Because by every metric, the market's overvalued, but that's, impossible to digest, yet also see this continue to go on. It's going to go on longer than it's supposed to, but then it's going to surprise you on the downside when it does happen.
Right.
So it's like the worst of both worlds, that you're, right all along, and then you still get surprised in the end.
Yeah, no, I agree with that. It's amazing. That's why, I always stress with folks when we're talking about trading, right? Especially in the retail world, you have to have some sort of disciplined pattern. Right. And it's got to be repeatable. And look, I totally make mistakes on it. And you're always thinking, oh, should I get out? I hit my mark. And then you're like, wow, it could go more, and then you start to say, that's why I love automation.
I made that mistake.
You throw that darn automation tool in there, and next thing you know, you take emotion out of the equation. You let the machine do the work, and you go sip margaritas on the patio while the machine's doing the work.
Well, it's brutal to be a covered call trader in this market because your long deltas when you sell covered calls, maybe not as many as if you just bought the equity, but you're continually right and probably winning, but the FOMO is just such a grind that like my 20 delta call got called away again. My 10 delta call got called away.
Right.
Yeah. You're underperforming.
Yeah.
Pretty much. That's right.
When you
That's
cover
right.
calls, you're underperforming.
Right. No. Good stuff. All right, guys. Good. Great conversation, Mark. Any sneak peek at the next blog letter, or Jason, yours as well?
Jason,
if you don't have it, don't tell us.
Jason doesn't do the it doesn't go the blog route, but soon we'll be launching some things. So.
All right. Fair enough. Mark, any sneak peek or no?
Writing about iterations today. Iterations in price discovery and pricing models.
Okay. Is that worthy of conversation, you think?
Sure. We can talk about a little bit of get into some binomial tree models, little Newton-Raphson method, and then a little floor anecdotes about price discovery.
I love it. Yeah, we have some good floor anecdotes about that. That was always fun. When we had Google as a DPM the first day it traded, we were the specialists in that. Can you imagine what the implied volatility was? I'm guessing it was too low, too high. What do you think? There were
probably a lot of how nows.
Yeah, right. How now? I'm like, okay, I get it. Too low, move them. We'll talk about that next week. All right, guys, have a great longest day of the year. There's all kinds of sales out there on the internet, and you put that code in, you get 20, 30, 40% off. It's unbelievable. I discovered that this morning on Instagram.
I'm just going to randomly put that in a promo code on anything.
Put it in anywhere. It works, anywhere. Jason from Adeum Funds, Vol.land, Mark from Harvested Financial. You can use those to go visit these lads. Don't forget to sign up for the hub.tradier.com for more great content. We're going to be having cool little things coming up in the near future on the hub. Little prizes, little games, little quizzes to win stuff. You never know what can happen. So all good, gents. You guys have a great weekend, and we'll see you next time on the Traders Workshop.
Happy trading.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.